think about your week for a second. You probably open an app to order Thai food on Tuesday night, right?
Definitely. Or pizza.
Yeah, exactly. Or maybe you hailed a car to get to the airport on Thursday morning.
Yeah.
Or, I don't know, you grabbed one of those electric bikes to get across town when you were running late.
Right. It's just everywhere.
It really is. You interact with this platform constantly. It is completely woven into the fabric of your daily routine. But have you ever paused to ask yourself, could you actually own the business behind it?
It's the classic hidden in plain sight scenario, really. We consume the service, we completely rely on the utility of it, but we rarely step back to evaluate the actual financial machine providing it.
Which is exactly what we're doing today. We are putting that machine under the microscope. Today's deep dive is all about Uber. And there is this absolutely fascinating paradox playing out right now that we really have to unpack.
It's a massive tug of war.
Right. Because on one hand, this is a business that is compounding its massive scale year after year. We are talking about staggering amounts of free cash flow being generated, like unbelievable numbers. And it's run by management that honestly seems to be pulling all the right levers.
Yeah, they've executed incredibly well lately.
They have. But yet, despite all of that pristine execution, its stock is down roughly 30% from its recent highs.
And that's the setup, right? The market is creating this high-stakes tug of war for investors. We really have to figure out if this business is, a once-in-a-generation growth compounder that is just temporarily misunderstood by the market, or if it is facing an existential threat from a single four-letter word, auto, as in autonomy.
I gotta say, I am coming into this deep dive feeling incredibly bullish. The financial turnaround this company has pulled off over the last few years is just mesmerizing to me. It's a completely different animal than the cash-burning startup it was a decade ago.
Well, I will gladly take the other side of that trade today.
I figured you would.
I mean, look, I see the cash flow numbers you're looking at. They're real. But I am heavily weighing the technological threats that are just massing on the horizon. If you change the fundamental physics of how a car is driven by, physically removing the human behind the wheel, you change the entire economic structure of this company.
The bull versus the skeptic. Let's do it. But before we get into debating the sci-fi future of robots driving us around, we really have to ground ourselves in the present.
Absolutely.
We have to understand what the machine actually does today. If you go out and buy a piece of this business, what do you actually own? Like, I know how to hail a ride, obviously, but what is the actual financial engine?
You really have to strip away the slick app interface and just look at the bare mechanics of it. At its absolute core, Uber is a two-sided marketplace.
Right.
It is a massive global matching algorithm. That's it. It matches people who need something moved with someone who is willing to move it. And there are three distinct pillars holding this entire structure up today.
Okay, let's walk through them in plain English.
So the first is mobility. This is the one everyone knows, obviously. It encompasses ride-sharing, traditional taxis that they have actually integrated into the app now, two-wheelers, and car rentals.
Moving humans from point A to point B.
Exactly, the core engine of moving human beings. Then the second pillar is delivery. Now, this started as just restaurant food, with Uber Eats.
Right, the pandemic really accelerated that.
Oh, massively. But it has expanded so aggressively into groceries, convenience stores, and even general retail now.
And what's the third one? Because I feel like people always forget the third one.
They do. The third is freight. This flies way under the radar for regular consumers, but it's basically their digital brokerage connecting corporate shippers with truck carriers.
Okay, so it's a B2B play.
Yeah, it operates in a much more cyclical, traditional logistics space. But the key is that it utilizes the exact same core matching technology as the other two pillars.
Okay, so we have mobility, delivery, and freight. But the unit economics of a single ride or, single delivery, that is where the magic seems to happen for me. How does this company actually capture value from those matching algorithms?
Well,
because they don't operate like a traditional transport or logistics company at all, right?
You're not even close. And what is most important to understand about Uber's business model is actually what they do not do.
Okay, what don't they do?
They do not own the cars. They do not pay for the gasoline or the routine maintenance. They do not cook the food in the restaurants. And crucially, they do not employ the drivers in a traditional salaried sense. The business is entirely asset light.
So they're essentially just sitting in the middle of the transaction.
Yes, they provide the digital matching layer. They maintain the servers, the routing algorithms, the payment processing, and, the trust and safety infrastructure.
Hmm.
And for providing that digital handshake between the rider and the driver, they collect a toll.
The take rate.
Exactly. In the industry, we call this the take rate.
Let's break that down mechanically for a second, just so we can really picture it. If I pay, say, $20 for a ride across town tonight, where does that money actually go?
Roughly speaking, the vast majority of that $20 passes straight through to the driver.
Right, to compensate them for their time.
Their time and the depreciation of their vehicle, gas, all of that. Uber simply skims a percentage off the top their take rate for facilitating the connection in the first place.
It is such a brilliant setup when you really step back and look at it. They are literally a toll booth on a highway they didn't have to pave.
That's a great way to put it.
And because they aren't buying physical depreciating assets like massive fleets of vehicles, their incremental cost to facilitate one extra ride or one extra food delivery is what? Practically zero.
Basically zero, yeah.
Yeah.
Once the software is written, the servers are running, and the local network in that specific city is established, spreading those fixed technology costs over billions of trips creates massive operating leverage. The platform just scales beautifully.
But the segments aren't just operating in silos, which is what I love. I've noticed how aggressive they are about pushing the cross-pollination between rides and delivery.
Oh, you mean the membership program?
Yes, the prime example is Uber One. I actually signed up for it a few months ago, and I realized pretty quickly that it completely changed my behavior. And they have crossed 50 million members in this program now.
The psychology behind a membership program like that is incredibly powerful for a marketplace. If you look at the internal data, those 50 million Uber One members are now driving roughly half of all mobility and delivery gross bookings.
Wait, really? Just 50 million people are generating half the total volume?
Yes, because the membership creates this potent behavioral shift. Think about the friction of choice. 5 years ago, if you needed a ride to the airport, you might open Uber, check the price, then open a competitor app, check the price, and just take whichever one was, like 50 cents cheaper.
Oh, I did that constantly.
Right. You were loyal to your wallet, not the platform.
But now, I'm paying $10 a month for Uber One.
Right.
I get free delivery on my food. I get discounted rides. So I don't even bother opening the other app anymore.
Exactly.
I feel like I actually need to use Uber just to sort of earn back the monthly fee I already paid them. It's a classic sunk cost fallacy, and it is working perfectly in their favor.
And it acts as a massive switching cost. Your payment rails are already saved in there, your ride history is there, your ratings are there, and the bundled benefits just make it completely irrational to look elsewhere. It creates this cohesive, self-reinforcing ecosystem that aggressively protects their market share.
Well, let's take that a step further, actually, because there is a hidden margin engine sitting inside this ecosystem that I feel like isn't talked about enough in the financial media.
Yeah, it's business.
Yes.
Right.
It's quietly scaling in the background, and it seems wildly profitable. I'm talking about the advertising business.
The advertising arm is fascinating because it leverages the exact same playbook that Amazon used to turn its retail marketplace into a huge profit machine. And actually, the same playbook Instacart used in the grocery space.
It makes so much sense. Think about it like a massive digital mall. In the past, Uber was just a landlord charging rent to the stores, right? They took their take rate from the restaurants or the drivers. But now they've realized they have hundreds of millions of people walking through their digital hallways every single day.
Specifically, they have roughly 199 million monthly active consumers right now.
Right. And those aren't just casual browsers. If I open Instagram, I'm just killing time. I'm scrolling. But if I open the Uber Eats app on a Friday night, I have my credit card in my hand, and I am actively looking to spend $30 on a meal right now.
The commercial intent is off the charts.
Exactly. That commercial intent makes that digital real estate incredibly valuable to advertisers.
So they charge restaurants for visibility. If a local burger joint wants to appear at the very top of your feed when you search for dinner, they pay a premium advertising fee to Uber.
And the beauty of it is the margin. Let's go back to that mall analogy. They are charging brands just to put a billboard up in the hallway. It costs Uber practically nothing in computing power to display that sponsored listing. So the profit margin on that advertising revenue is virtually 100%. It falls straight to the bottom line.
Yeah. The advertising revenue is heavily inflating their overall profitability without them having to add any new physical infrastructure or drivers. It is pure high-margin software revenue.
Hearing you describe this digital toll booth, with its high-margin ads and its sticky membership program. I mean, it makes it sound almost inevitable. Like, of course, you just set up a server and print money.
Right, it sounds easy in retrospect.
But anyone who lives through the 2010s knows Uber was the complete opposite of an efficient machine for a very long time.
Oh, historically, it was the absolute poster child for Silicon Valley excess.
The early days were wild. It was a notorious cash furnace. They were subsidizing rides just to force their way into new cities. I remember taking hour-long rides that cost me, like, $12.
And the driver was probably getting paid $30.
Exactly.
Mm.
Uber was just burning venture capital money to make up the difference. It was growth at all costs, completely unsustainable.
And this transition from a cash furnace to a profit engine brings us to a really crucial investing framework. Warren Buffett talks extensively about the necessity of finding the right jockey to ride the horse.
Right, the jockey and the horse.
You can have an incredible business model, a great horse, but if the management team, the jockey, is reckless with capital, they will run that horse straight into the ground.
So the current CEO, Dara Khosrowshahi, is the jockey we need to evaluate here.
Yes, and we have to analyze him strictly as a capital allocator. When he took over the company, he inherited a sprawling, chaotic, deeply cash-burning empire. His mandate wasn't just to grow the top line anymore. His mandate was to completely transform the company into a disciplined financial machine.
How do you actually measure that discipline, though? Because it's really easy for a CEO to say they are disciplined on an earnings call.
You measure it by looking at what they choose not to do.
Okay, give me an example.
The premier example of Khosrowshahi's discipline is how he handled their self-driving car division.
Oh, right. The in-house unit.
In the early days, Uber was terrified that if someone else invented autonomous vehicles first, their platform would be obsolete overnight. So they spent billions, literally billions of dollars trying to build their own autonomous vehicles in-house. It was a massive, highly experimental cash drain on the company.
But Khosrowshahi eventually pulled the plug.
He looked at the division, realized it was bleeding the core business dry, and recognized that manufacturing physical robotics was just not their core competency. A poor capital allocator would have succumbed to the sunk cost fallacy and just kept throwing money at the vanity project.
Hoping for a miracle.
Right. But Khosrowshahi wisely sold off that in-house unit to stop the bleeding.
That marks a massive psychological shift for the company.
Huge. It signaled a pivot from an empire-building mindset to a strict return on invested capital mindset. He realized Uber doesn't need to build the car. They just need to partner with whoever eventually builds the car. Under his leadership, they cleaned up the balance sheet, achieved investment-grade status, and fundamentally stopped subsidizing unprofitable growth.
Okay, so we have a highly scalable business model, and we have a jockey in the saddle who actually respects capital.
Yes.
But how wide is the castle's moat? Because if they don't own any cars or employ any drivers directly, what stops an aggressive tech giant from building a slicker app tomorrow and just stealing their market share?
To answer that, we really should lean on Pat Dorsey's framework. Dorsey wrote a fantastic book called The Little Book That Builds Wealth, where he categorizes durable competitive advantages moats into 4 specific buckets.
Right.
And for Uber, we can see 3 of these buckets clearly at play.
Let's apply them. Start with the most obvious one.
Network effects. Dorsey defines this as a wide moat. And for a two-sided marketplace like Uber, it is the absolute lifeblood of the company. It functions as a self-reinforcing loop.
Explain the loop.
More riders opening the app attracts more drivers looking for fares, right? When you have a high density of drivers, the wait times plummet and the pricing becomes much more stable for the rider.
And a 3-minute wait time is a vastly superior product to a 12-minute wait time.
Precisely. That superior low-friction experience attracts even more riders, which in turn attracts even more drivers. The mathematical density of the network literally is the product.
But here's the catch with that liquidity, and I think it's important it is entirely hyperlocal. Winning the market in New York City and having 1 million drivers there doesn't help you at all if you are trying to launch the app in Tokyo or London.
Not one bit.
You have to build that critical mass of riders and drivers block by block, city by city, all over the entire world.
And that local density is incredibly hard and expensive to replicate from scratch, which leads directly to Dorsey's second bucket, cost and scale advantages.
Right.
Because Uber is now facilitating billions of trips a year globally, they can spread their massive fixed technology, compliance, and marketing costs over a massive base. A startup trying to compete in just one city has to build the exact same foundational app infrastructure, but they have far fewer rides to amortize that cost over.
And the drivers themselves actually benefit from that scale too. A single driver can deliver food during the lunch rush, then switch over to driving passengers during the evening commute, and then maybe take a grocery delivery on their way home.
That cross-utilization is huge.
It is. It keeps the driver earning money consistently, which ultimately lowers Uber's unit cost compared to a rival that only offers rides or only offers food.
Exactly. And Dorsey's third bucket is switching costs. We touched on this with the Uber One membership. Historically, this moat was very weak. People were mercenary. They would just switch apps for a 50-cent cheaper fare.
Yeah, the loyalty was zero.
But with 50 million members locked in, those switching costs are increasing rapidly.
This brings up one of my favorite thought experiments in investing. I like to call it the $10 billion moat test.
Oh, I love this one. Walk us through it.
Okay, so imagine I find a rational, deeply experienced tech executive. I sit them down, I hand them a check for $10 billion. I look them in the eye and say, your sole mission is to destroy Uber's business. Go. Could they do it?
If we look at the last decade of history, the answer is a very confident no.
Just look at the graveyard of companies that tried. Didi tried to expand globally and eventually had to retreat. Look at all those well-capitalized startups that tried to blend billions of dollars to steal human driver liquidity from Uber. They basically all failed.
They did.
They learned the hard way that you simply cannot buy network liquidity faster than the incumbent can defend it. If the challenger subsidizes fares, sure, the riders flock over for a bit. But the minute the venture capital money runs out and prices normalize, the riders go right back to the platform that has the most cars. The network effect was just too thick to pierce.
I agree completely. Against human challengers trying to replicate a human-driven network, the moat is formidable. But we need to put a pin in that thought experiment.
Uh-oh.
Because later on, I am going to explain how the rules of the $10 billion test have fundamentally changed.
I have a feeling we're going to circle back to the robots.
We absolutely are.
But before we look at the threats on the horizon, we need to look at the financial scorecard today.
Yeah.
Because the numbers this business is putting up are just massive.
They are impressive, but they require a very careful reading.
Let me just lay out the headline scale first. Look at the full-year scorecard for their recent fiscal year. Gross bookings hit $193 billion.
Huge.
That is the total amount of money flowing through the platform globally. $193 billion. And from that toll booth model we discussed, they generated $9.8 billion in free cash flow. That free cash flow figure was up over 40% year over year.
Incredible growth.
And operating income was up 99%. They essentially doubled their operating profit while revenue grew at a much slower clip.
It is the absolute signature of operating leverage. The profits scale faster than the revenue. But this is where we need to slow down and enter the real heart of our deep dive.
Quick break. This show is built on the fundamental research of Yehonatan, our lead analyst and founder. Want his tools? Click the Substack link below to get 3 free resources for this company. The full deep dive PDF, an interactive valuation model to test your own growth and discount rate scenarios, and a 20-year financial spreadsheet, all completely free. Now back to the numbers.
To actually understand Uber's valuation, we have to teach a mini masterclass on Warren Buffett's concept of owner earnings.
Let's do it. Why do owner earnings matter more than the headline profit?
As an investor, you have to understand the profound difference between an accounting opinion and cold hard cash.
Okay.
GAAP net income, the number that gets plastered across the financial news headlines, is essentially an accounting opinion. It is subject to endless rules, estimations, and non-cash adjustments. Buffett built his entire career on ignoring that headline number.
What does he look for instead?
He hunts for owner earnings, which is essentially the actual cash an owner could pull out of the business at the end of the year without harming its future operations.
Because, accounting profit can be conjured by a spreadsheet entry that doesn't actually move a single dollar. While cash, well, it either hits your bank account or it doesn't.
Exactly. When the accountants and the bank account disagree, Buffett trusts the bank account. And nowhere in the public markets is that gap wider and more illustrative than at Uber right now.
Really?
Oh, yeah. The income statement is an absolute minefield of distortions. We need to unpack 3 massive distortions to help you, the listener, feel the gap between what the headlines say and what cash actually entered the building.
Okay, let's tackle distortion number 1. I was looking at their income statement, and it said they made nearly $10 billion in net income recently. But you're telling me a huge chunk of that is a phantom tax windfall.
Yes. If you dig into the footnotes of that massive profit number, you discover that about $6 billion of it came from a one-time accounting maneuver. It's called a deferred tax valuation allowance release.
I am definitely going to need you to translate that into plain English. Are you saying $6 billion of their reported profit wasn't actually cash generated from giving people rides?
Not a single dollar of actual cash entered the business from that specific $6 billion line item.
Wait, how is that legal? What is the actual mechanic happening there?
Think of it this way. For a decade, during that cash furnace era we talked about, Uber lost billions of dollars, right?
Right.
Well, the tax code is somewhat forgiving. It allows you to bank those historical losses as credits against future taxes, assuming your business eventually turns around and becomes profitable.
Okay, that makes sense.
But the accounting rules require conservatism. You cannot count those future tax credits as an asset on your balance sheet unless it is more likely than not that you will actually generate enough future profit to use them.
So for years, the accountants looked at Uber's massive cash burn and said, yeah, there's no evidence you will ever be profitable, so we aren't letting you claim these tax credits on the books.
Right. They placed a valuation allowance against those credits, effectively reducing their value to zero on the balance sheet. But then, Khosrow Shahi's turnaround took hold. They started generating massive free cash flow.
So the math changed.
Suddenly, the accountants looked at the 3-year projections and said, okay, the data has changed. We now believe you are going to be profitable enough to use these old tax credits. So they released the valuation allowance.
And the mechanical result of releasing that allowance is that they get to book the value of those future tax savings as an immediate profit today.
Yes. They ran a roughly $6 billion non-cash benefit through the income statement. It artificially inflated their net income to look like a historic blockbuster year, but the actual cash in the bank didn't change by a single dime that day.
That is wild.
It is just a bookkeeper's optimism about the future dressed up as current earnings.
It completely skews the perception of how the core business actually performed that year. Okay, so what is distortion number 2?
Distortion number 2 cuts in the exact opposite direction. It is the mark-to-market roller coaster.
This has to do with their investments in other companies, right?
Yes. Over the years, as Uber retreated from certain international markets, they sold their local operations in exchange for equity stakes in the dominant regional players. Today, they hold large equity stakes in publicly traded companies like Didi in China, Grab in Southeast Asia, and Aurora, the self-driving technology company.
And here is where the accounting rules force another massive distortion, I assume. Every single quarter, Uber has to look at the stock prices of those external companies, reprice the value of their stakes, and run that change straight through their own net income statement.
It creates an absurd dynamic. Let's look at a recent quarter. The broader stock market had a pullback, and the share prices of companies like Grab and Didi fell. Because of that, Uber was forced to report a $1.5 billion equity paper loss on their income statement. It absolutely crushed their reported net income for the quarter.
But they didn't sell any shares. They didn't lose any actual operating money.
Nope.
The core business, the rides, the Uber Eats deliveries, the freight matching could be executing flawlessly, adding millions of new users and generating cash. But the headline numbers look terrible simply because the stock market in Singapore decided to lower the price tag on Grab that month.
It is totally detached from their operational performance. When those external stocks go up, Uber reports a phantom gain. When they go down, a phantom loss. It creates so much noise that year-over-year comparisons of their GAAP net income are virtually useless for understanding the health of the core marketplace.
Okay, so the tax windfall flatters the earnings and the mark-to-market losses punish the earnings. We strip those out to find the real cash flow. But there's a third distortion. I want to push back on the bull narrative here a bit. Distortion number 3 is stock-based compensation.
The cost that many tech investors love to ignore.
Right, because when we calculate free cash flow, we start with operating cash and we subtract capital expenditures. But when Uber pays its software engineers in company stock instead of cash, the cash flow calculation actually adds that expense back in.
Because technically, no cash left the building to pay that engineer.
Exactly. It makes the cash flow look fantastic. But isn't paying employees in stock a very real economic cost? I mean, doesn't it dilute me as an owner?
You are absolutely right. Warren Buffett is famously scornful of companies that pretend stock-based compensation is free. He argues that it is a very real cost to you as an owner because it slices the ownership pie into ever smaller pieces. Your claim on the company's future cash flows is diluted every time they issue a new share to an employee.
So if it's the real cost that dilutes owners, how does the bull case reconcile that with the massive free cash flow numbers? Are the numbers just fake?
No, you reconcile it by looking at the second half of the equation, capital allocation, specifically their share repurchase program. Yes, Uber is diluting shareholders by issuing stock to employees, but they are simultaneously executing roughly $3 billion per quarter in stock buybacks.
So they are taking their genuine, hard-earned cash from the toll booth, going into the open market and buying up their own shares to retire them.
They are using real cash to sop up that dilution. Cash flow generation and capital allocation have to be read together. Because they are aggressively buying back roughly $3 billion a quarter, they are actually outbuying the dilution. The share count is shrinking, meaning your slice of the pie is finally getting larger, not smaller.
That buyback program is a massive signal. The company itself is acting as the most informed insider in the building, and they are buying aggressively.
And they aren't the only ones buying.
No, we have to talk about the validation from Wall Street here. Bill Ackman's firm, Pershing Square, has built a massive position in Uber. We are talking about roughly 30.3 million shares. That is a roughly $3 billion position for his fund.
It is an incredibly loud endorsement from one of the most scrutinized investors in the entire market. Ackman runs a highly concentrated portfolio. He only owns a handful of businesses at any given time, and he made Uber a centerpiece.
What he sees seems to mirror exactly what we've been discussing, right? A dominant platform, a widening moat, improving unit economics, a massive free cash flow inflection, and a company actively shrinking its share count.
I acknowledge the magnitude of that validation, absolutely. But we should heed the advice of Seth Klarman here. Klarman is another legendary value investor, and his framework would remind us that conviction is not analysis.
Meaning, don't just blindly follow the billionaires.
Exactly. Following super investors blindly is a dangerous game. You cannot just ride Ackman's coattails without doing your own homework, because a multi-billion-dollar hedge fund can afford to be wrong, or they can hedge their bets in ways that a retail investor simply cannot. You have to understand why he thinks the market is mispricing the company.
Well, the $9.8 billion in free cash flow certainly provides a comforting blanket for that thesis. So we know the financial engine generates massive cash today, but where does the future growth come from? To justify a growth valuation, they can't just be a mature utility that has peaked.
Right. And to frame the growth story, we can apply Peter Lynch's classic philosophy.
The famous buy what you know mantra.
Exactly. Lynch argued that the best investment ideas don't come from complex Wall Street models. They come from observing your own ordinary life. You, the listener, probably used Uber this morning. You see the delivery drivers in your neighborhood.
It's tangible.
It's not some obscure enterprise software company where you need a computer science degree to understand if the product is actually good. The utility of the business is obvious and hiding in plain sight.
But, familiarity alone isn't an investment thesis. Just because I buy coffee at a local shop doesn't mean it's a globally scalable stock.
Lynch would agree. Familiarity is just the starting point to get it on your radar. From there, you have to look at the growth runway and the valuation mechanics. Conceptually, we can look at the PEG ratio, the price-to-earnings growth ratio.
For those unfamiliar, without getting bogged down in specific numbers, the PEG ratio basically asks a simple question. How much of a premium are you paying for each unit of expected growth?
It connects the current valuation to the future velocity of the earnings. And what we see with Uber is a growth story that still has a surprisingly durable 5 to 10-year runway ahead of it. Mobility penetration in massive international markets is still relatively low compared to the U.S. Delivery is rapidly expanding beyond restaurant food into high-frequency grocery and retail habits.
And because of that operating leverage we discussed earlier, the fact that the tech infrastructure is mostly a fixed cost, every new dollar of revenue drops disproportionately to the bottom line.
Management themselves have actually noted that their earnings and free cash flow are scaling at more than twice the rate of their top-line revenue growth. When earnings are growing that much faster than revenue, the PEG ratio compresses. Conceptually, it sits in a zone that Lynch would historically categorize as highly attractive.
It seems like that rare Peter Lynch archetype, a company that started as a fast grower burning cash to violently expand its footprint and has successfully morphed into a highly profitable stalwart without losing its forward momentum. That pivot is incredibly difficult for a tech company to pull off.
It is extremely rare. But the market is not blind to this execution. If a stalwart with $193 billion in gross bookings and massive free cash flow is trading at a steep discount from its highs, there is a reason. This multiple isn't a market oversight. It is the price of anxiety.
Which brings us to the narrative shift. If the numbers are this pristine, the accounting distortions are well understood, the cash flow is this strong, and the growth runway is steady, why the immense anxiety? Why is the stock down roughly 30% from its recent highs?
Because of the existential threat, it's time to steelman the bear case. We have to look the autonomy threat dead in the eye.
We are talking about Waymo and Tesla.
We are. Let's go back to the unit economics of our ride that we discussed in the very beginning. We established that the human driver accounts for roughly 60 to 70% of the cost of a typical ride-hail trip. The driver is the most expensive, least predictable component of the entire network.
So if you can physically remove the human driver from the equation, the economics of this entire $200 billion global market are suddenly up for grabs.
Entirely up for grabs. And the technology to do that is no longer science fiction.
No, it's out on the streets today.
Waymo and Tesla possess the artificial intelligence, the manufacturing capabilities, and the massive balance sheets to chase that prize. And crucially, they do not need to ask Uber for permission to enter the market.
The evidence of this disruption is starting to pile up, and it is chilling if you own Uber stock. Let's look at what Tesla's doing.
Tesla is pushing a camera-only, highly decentralized autonomous model. They manufacture millions of their own cars. And look at their recent pilot programs. In their Austin pilot, reports show they were offering autonomous fares roughly 60% below standard UberX pricing.
60% cheaper. I mean, if I open an app and a ride is $10 instead of $25, I don't care if there's a driver in the front seat or not, I'm taking the cheaper ride.
Exactly. If a network of millions of self-driving Teslas needs no third-party marketplace to connect them to riders because the Tesla app natively is the marketplace, Uber is bypassed entirely.
And Waymo is attacking from the premium side.
Waymo is proving that highly regulated, sensor-heavy, driverless models actually work at commercial scale today. They are live and expanding in multiple major U.S. metropolitan areas right now. If Waymo scales its own proprietary fleet of vehicles and routes riders exclusively through its own standalone app, Uber gets entirely disintermediated. The bear case in a single sentence is this. If the robotaxi manufacturers own the fleets and control the consumer-facing apps, Uber becomes a thin, completely unnecessary layer of software that gets squeezed out of existence. The toll booth gets demolished.
Okay, there's a terrifying bear case.
Yeah.
It really is. But I'm fiercely countering this. The bull's defense against autonomy is incredibly strong, and it centers on one vital concept: the indispensable demand layer.
Make the case. Why wouldn't a robotaxi company just crush them?
Because scale still matters. Network effects still matter, even when the cars are driven by robots. There is a crucial anecdote regarding scale that the market completely ignores right now. Uber logs more trips in a single morning globally than Waymo does in an entire year.
That is a staggering disparity in demand density.
It is everything. Think about the brutal economics of operating a robotaxi fleet. A fleet owner, whether that's Waymo or a third-party logistics company buying Teslas, is purchasing a depreciating asset that might cost $80,000 to $100,000.
Right. Massive upfront capital.
The absolute worst-case scenario for that fleet owner is for that wildly expensive robot to be sitting idle in a parking lot, waiting for a rider to open a niche app. A robotaxi only earns a return on capital when there is a passenger in the back seat. They require relentless high utilization rates to survive.
They need non-stop demand generation to make the math work.
And who has the most demand density on the planet? Uber. With nearly 200 million active consumers opening the app, Uber provides the global liquidity that keeps those expensive robotaxis moving. Waymo actually ran cars on Uber's network in cities like Austin and Atlanta. And the reports from those partnerships showed that cars operating on Uber's routing network saw roughly 30% more trips per day and much shorter idle wait times than platforms trying to run standalone robotaxi apps. The fleet owners fundamentally need Uber's massive demand network to make their own unit economics viable.
That's a fair point. Furthermore, a standalone robotaxi fleet lacks the dynamic flexibility of a hybrid network. Autonomous vehicles cannot currently serve every obscure route. They struggle with complex drop-offs or severe weather conditions. Crucially, a fixed fleet of, say, 5,000 robotaxis cannot instantly absorb a massive spike in demand, like when a stadium concert lets out and 20,000 people need a ride at the exact same minute.
They just don't have the flex capacity.
Yeah, right. A hybrid network like Uber, which blends autonomous vehicles for baseload routes with millions of human drivers who log on during surge pricing, can dynamically absorb those demand spikes in a way a rigid robot fleet cannot.
Yes. Uber isn't trying to build the car anymore. They are courting all the manufacturers. They are positioning themselves to be the neutral operating system, the ultimate demand layer for everyone's autonomous fleet.
The debate really boils down to the tier of the competitor. The second-tier autonomous players absolutely need Uber's demand to survive. But the giants, Tesla and Waymo, have the resources, the brand recognition, and the capital to try and own the entire stack: the car, the software, and the customer. The question is whether they will succeed in replacing a 13.6 billion trip global network.
Which brings us directly to the market's current verdict. We have this perfectly executing business today, generating billions in cash, colliding with this massive technological uncertainty tomorrow. And the result is a stock that is down roughly 30% from its highs.
We need to have a fierce qualitative debate about the nature of this price action. Is this an irrational panic, or is it a logical, necessary repricing of risk?
I'm channeling Benjamin Graham here. Graham introduced the foundational concept of Mr. Market, this manic depressive business partner who offers to buy or sell your shares every single day. Sometimes Mr. Market is wildly, irrationally optimistic, and sometimes he is deeply irrationally depressed. To me, this 30% drop is Mr. Market having a massive mood swing.
A mood swing?
Yes, the underlying business is executing flawlessly. The free cash flows are exploding. The buybacks are steadily retiring shares. Yet the market is panicking over slow-moving sci-fi headlines about robotaxis that are still struggling to scale nationally without human intervention. The market is projecting a worst-case scenario that is a decade away and letting it completely overshadow a pristine financial reality today. It's a massive overcorrection.
Well, I am going to channel Seth Klarman. Klarman focuses heavily on the concept of the margin of safety. He teaches investors to rigorously distinguish between risk, which is the probability of a permanent loss of capital, and uncertainty, which is simply a wide, unpredictable range of future outcomes. I argue that this 30% drop is not a mood swing. It is a highly rational repricing by a forward-looking market.
Rational. How is punishing a company that just grew operating income by 99% rational?
Because the stock market is a discounting mechanism for the future, not a report card for the past. The market is heavily weighing the possibility, the very real structural risk, that Uber's core mobility product, which generates roughly half its gross bookings, could be fundamentally obsolete or face severe margin compression in a decade. When the range of outcomes for a business expands to include an existential threat from better technology, the market rightly demands a lower valuation multiple to compensate for that uncertainty.
So you think they're right to be scared?
The market is simply saying, I refuse to pay a premium, risk-free growth multiple for a company whose primary moat is currently under siege by trillion-dollar tech giants.
But the pessimistic outcome is already reflected in the multiple. If you look at the growth expectations implied by the current valuation, it assumes the growth engine practically grinds to a halt. It gives them zero credit for the thriving delivery business, zero credit for the high-margin advertising business, and zero credit for their massive international runway. The market is acting as if the obsolescence of the mobility network is a near certainty, rather than just one possibility among many.
And that dynamic is exactly what creates a margin of safety for a value investor if, and only if, you believe the worst-case scenario will not materialize. If the current price already heavily reflects the pessimistic outcome, then the risk of a permanent loss of capital is reduced, provided the business continues to generate cash and adapt. But make no mistake, the uncertainty is real. The fundamental shape of this investment story has permanently changed from a pure, frictionless software growth narrative into a highly complex, capital-intensive technological battle.
It is a fascinating standoff, and we have to be very careful here to establish the guardrails of our discussion. We are strictly debating the shape of this story and the mechanics of the business. We are not discussing specific share prices, we are not setting price targets, and we are not churning out valuation models. We're looking purely at the conceptual battle between a flawless operational execution today and a deeply uncertain technological landscape tomorrow.
Exactly. We are entirely focused on evaluating the durability of the moat and the structural threats it faces.
So as we wrap up this deep dive, what does this all mean for you, the listener, as you evaluate this business? Let's synthesize this debate down to its core.
It all comes down to one critical variable. The bull and the bear actually agree on the present reality. The business today is exceptional, the unit economics are highly profitable, the free cash generation is undeniable, and the management team has proven to be disciplined allocators of capital.
The entire divergence rests solely on the future. It rests on whether autonomy makes Uber more valuable, acting as the indispensable global demand layer that every fleet owner relies on to maintain utilization and avoid bankruptcy, or less valuable, becoming a bypassed toll booth on a highway now controlled end-to-end by Tesla and Waymo.
And this is where I turn the question explicitly over to you, the listener. We have laid out the frameworks, the accounting realities, the growth runways, and the existential threats. But this is the ultimate unresolved dilemma that you have to weigh for yourself. Do you believe Waymo and Tesla's technology will inevitably win and capture the direct customer relationship? Or is Uber's global multimodal network moat simply too powerful to break?
It is a question of human habit versus technological disruption.
It's something to think about the next time you open the app to order dinner or catch a ride.
Speaking of apps you open without thinking, here's a question for your next vacation. Have you ever flown to Europe, booked your hotel on Booking.com, and wondered, wait, could I actually OWN the company taking that reservation? Same idea as Uber, a business you already use without thinking about it. Next time, Booking goes under the same lens.
If you enjoyed today's analysis, make sure to follow the show on your favorite podcast app so you never miss an episode. As a reminder, this podcast is for informational and educational purposes only and does not provide financial, investment, or legal advice. Investing involves risk, and you should always do your own fundamental research and consult a qualified professional before making any financial decisions. Thanks for listening, and we'll see you next time.